Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. So will Q1 be worse than Q4? That's the question that Dirk poses this week, and the question that he's going to answer for us. My guess is, in a word, yes.
Yeah, it looks like it probably will. Right now, for sort of combining those that have already reported with the handful that have yet to report, for Q4, we're looking at a decline of 34%. Now, the expectations for Q1 aren't quite as bad right now. They're down 31%. However, the trend is very much in place of the estimates coming down. 3 percentage points is not much to make up in 3 months. And so I suspect it's going to be significantly worse than the fourth quarter.
And sectors that could see some of the major losses include?
The usual suspects, the financials, materials, consumer discretionary, industrials, tech, energy. Energy is probably going to be off about 50%.
Yeah, that's kind of like a new one on the list.
Yeah, I mean, although in their defense, they're working off of very difficult comps. Same is not true for say the financials, but the materials and the consumer discretionary, we're both looking off by about 2/3.
Well, some of the analysts here are looking for a little bit of a recovery in Q3. So does that mean that they're still too optimistic?
I think they are. In that, if you look at the full year expectations, we're looking for a decline of about 11.2% at this point, which translates to a earnings for the S&P 500 of about $64. However, that's down from almost $74 just a month ago. And if there's anything that I've learned in the quarter century of looking at earnings expectations data, you have to look at the trend and sort of extrapolate things. It seems to me far more likely that we're going to have total earnings for the S&P 500 down closer to $50 for all of 2009. And at that point, then you really have to say, what kind of multiple am I willing to put on those earnings? With the S&P at approximately 800, you're talking about 16 times earnings at this point, and then either I've got to be all wet about total earnings of about 50, which I really don't think I am, but there is always that fog of time and ignorance that always clouds the future.
Right.
Or you've got to be willing to put a higher multiple than 16 on those earnings for the market to make any progress. Now, one can argue, all right, these are depressed earnings, and also, we've got pretty low interest rates, again, provided that you happen to be the U.S. government. If you happen to be a company with less than sterling credit, then no, interest rates are not very low for you.
Right.
And it's also an environment of low inflation, indeed negative inflation. Now, historically, low inflation has tended to be associated with pretty high PE ratios. That really hasn't been tested in a deflationary environment.
Okay, so here's the question. If there are still some analysts out there who are still too optimistic in the way they're looking at these earnings, either from the top down or bottom up, doesn't really matter. What's it going to take to pull them back into the real world?
Well, I think they'll just get continuing data that says, no, you're too optimistic, and they'll continue to cut their forecasts as they...
So the data will beat them down.
The data will beat them down, and we're seeing that happen. I mean, we're still getting about 5 estimate cuts for every estimate increase. I don't see that changing anytime soon, but if it does start to change, I'll be down here telling you about that.
All right. So, but then the other people say, well, the decline has to stop sometime.
Does it?
That's what I'm here to ask you.
I mean, there is nothing, written in stone that says that we have to turn this thing around. Yes, there are a couple of potential hopeful things on the horizon. I mean, the stimulus bill should help things a bit. It does strike me as being really too small to totally get the job done, but it will cushion the decline somewhat. Yes, there will be pent-up demand over time, but we've already pulled forward an awful lot of demand for very important durable goods, and that tends to be the swing factor. You still have rising unemployment, and that process has got a lot more to go.
So bottom line, median estimates for Q109 versus Q108, decline of what?
Well, as I said, right now they're looking at 31%. I would not be shocked to see a minus 40% type number when all is said and done.
And the trend continuing then for Q2?
I don't have a real good handle on the Q2 numbers. It will definitely be down on a year-over-year basis, but maybe it will be down less than the 40%. That would be the first indication that things are starting to get better, having declining year-over-year declines.
Okay. So Dirk tells us in his current earnings trends commentary that the rate of decline in earnings expectations for both this year and next, downright scary. If you want to read more about that and find out all of the numbers in all of the tables that he puts together, get over to Zacks.com and click on the headline that is right next to his picture on the bottom of the homepage, and it will take you right to his most recent data and his most recent thinking on earnings for Q1 coming up. I'm Terry Ruffalo with Dirk Van Dyke.